Yeah, welcome. Today we are going to talk about value gap. Fair value gap. Yeah, I just want to show you this on deriv volatility 100. It says that is index, and where I want to show you this is on a 4 hours time frame. When you are looking for a fair value gap, there are 3 consecutive candles you need to look at. Just like if you look at this candle, 1, 2, 3, then you look at this other one, 1, 2, 3. Okay, whenever there is a gap that is unmitigated, you see this low push, you see that there is this gap between here and here. That's the low of the previous candle and the high of the immediate after candle. That's the low of this candle here and this doji candle here. Okay, the low of this doji candle here and the high of this candle here. You see there is a gap in between them. There is this gap between here and here. There is this gap between here and here. So when there is such a gap, that is what we call fair value gap. When there is such a gap, the market will come back and mitigate that gap, which means cover it. For every candle, there is always a cover between the previous and the after. But in this case, there is none, between this doji and this one. So that's a fair value gap, and if you look at these 3 candles again, 1, 2, 3, you see that there is an unmitigated gap between here, the low of the previous candle and the high of the after candle. If you look at this candle, the top here did not mitigate this gap. There is a gap here. So this is another fair value gap. So you see that the market went down. Which one is easier to mitigate in between the 2 fair value gaps? I mean, this one and this one. Which one is easier to mitigate? It was this one that is easier to mitigate. That is why it came down here and then came up and mitigated this gap, this fair value gap. And fair value gap is mitigated only once. So when the market mitigated this one, then it went down. Then as you can see, as you can see, then the market came back up. You see, it came back to this other block, to this other block now, and mitigated it, and we are looking to go down further. So as it mitigated this one, which is a bigger one, there is likelihood this low will be broken. So that is just it. If you look at other ones, if you look at the push-ups, there is another fair value gap here. There is a fair value gap here. If you look at this, there is a fair value gap here between this and this candle. So this market will come down here, test this, probably go up and then push back down, because the general outlook of this volatility 100 is bearish, right? This market could come here, mitigate this fair value gap here between here and here, mitigate this fair value gap, then push up to test this area again, and then later push down. So Fair value gap generally is when you have three candles in the same direction, like this, 1, 2, 3, and then there is a space that is unmitigated between the three candles. That is where fair value gap is, right? If you look at this candle, 1, 2, 3, this one, 1, 2, 3, so there is this space here and this space here. That is the space this market will come down to this area to look at and then push up to see if it can mitigate this top, to break this top and push up further. But if it fails to break this top, then it is coming to this to test this other one, this other fair value gap. If you see 1, 2, 3, you see from this space here to this space here, it will come down, push down to try to mitigate this one, and if it fails to push up further, then it will continue to go down. So in this place, you see that there are 3 fair value gaps. There is one here, but that's not much. But there is one here, 1, 2 here, and then there's another one here, 1, 2, 3, another one here. So if you do price action trading, those are the things you should be looking at, and I hope that I have shown you light as to the understanding of what fair value gap is. And if you find value in this video, kindly like and follow and share, so that when I produce another video, you will be notified. Thanks and God bless.